Introduction. In accounting, profit shown by the profit and loss account does not always represent the amount that can be freely distributed to owners. Certain amounts must be retained to meet future obligations, possible losses, or to strengthen the financial position of the business. For this purpose, accountants use two important concepts, provision and reserve. Although both provisions and reserves involve setting aside a part of profit, they differ in their purpose, necessity, accounting treatment, and impact on financial statements. A clear understanding of the difference between provision and reserve is essential for preparing final accounts correctly and for answering examination and interview questions confidently. Meaning of provision. A provision is an amount set aside out of profits to meet a known liability or loss, the exact amount of which cannot be determined with certainty at the time of preparing accounts. The liability is certain to arise, but its value is estimated based on prudence and past experience. Hence, provision is created to ensure that profits are not overstated. Examples of provision. Provision for bad and doubtful debts. Provision for depreciation. Provision for taxation. Provision for warranty claims. Key characteristics of provision. Created for known losses or liabilities. Compulsory to create. Treated as an expense. Reduces net profit. Shown as a deduction from the concerned asset or on the liabilities side of the balance sheet. Meaning of reserve. A reserve is an amount set aside out of profits to meet future or unknown contingencies or to strengthen the financial position of the business. Reserves are created after determining net profit, and their creation depends on the decision of management, not on necessity. Examples of reserve. General reserve. Capital reserve. Revenue reserve. Dividend equalization reserve. Key characteristics of reserve. Created for unknown future needs. Not compulsory to create. Not treated as an expense. Does not reduce net profit. Shown on the liabilities side of the balance sheet. Basis of difference between provision and reserve. 1. Nature. Provision is created for known liabilities or losses, whereas reserve is created for future uncertainties or financial strengthening. 2. Necessity. Provision is mandatory, while reserve is optional. 3. Effect on profit. Provision is charged against profit and reduces net profit, whereas reserve is an appropriation of profit and does not affect net profit. 4. Accounting treatment. Provision is treated as an expense, while reserve is treated as a distribution of profit. 5. Purpose. Provision ensures true and fair view of financial statements, whereas reserve provides financial stability and internal strength. Accounting principle involved. Provision and the principle of prudence. Provision is based on the principle of prudence, conservatism, which states that all anticipated losses must be provided for, while anticipated gains should not be recognized. This ensures that assets and profits are not overstated, thereby presenting a true and fair view of financial statements. Reserve and the principle of appropriation. Reserve follows the principle of profit appropriation, where profits already earned are deliberately retained for future use or business expansion. Impact on financial statements. Effect on profit and loss account. Provision is debited to the profit and loss account before calculating net profit. Reserve is created after net profit is determined and is shown in the appropriation section. Effect on balance sheet. Provision reduces the value of the related asset, example, provision for doubtful debts reduces sundry debtors. Reserve appears under shareholders' funds on the liabilities side. Disclosure and presentation differences. Disclosure of provision. Provisions are shown either as a deduction from the concerned asset or as a current liability, depending on their nature. Disclosure of reserve. Reserves are always shown separately under reserves and surplus. They are never adjusted against assets. Use and utilization. Use of provision. Provision can be used only for the purpose for which it is created. For example, provision for doubtful debts cannot be used for payment of dividends or expansion. Use of reserve. Reserve can be used for distribution of dividends, for business expansion, for meeting unforeseen losses, for issuing bonus shares. Creation in case of loss. Provision in case of loss. Provision must be created even if the business incurs a loss, because the liability or loss is expected to arise. Reserve in case of loss. Reserve cannot be created if there is no profit, as it is an appropriation of profit. Legal requirement aspect. Under company law and accounting standards, certain provisions, like provision for depreciation and taxation, are legally compulsory. Creation of reserves is generally voluntary, except when specific laws mandate them, example, statutory reserves. Reversal and excess amount. Excess provision. If a provision is found to be excess, it is written back to profit and loss account. Excess reserve. Excess reserve is carried forward or transferred to another reserve as per management decision. Nature in true and fair view. Provision directly helps in presenting a true and fair view of profits and assets. Reserve enhances the financial stability and credibility of the business but does not affect the accuracy of profit measurement. Common examination traps, very important. Provision is not an appropriation of profit. Reserve is not an expense. Provision can exist without profits. Reserve cannot exist without profits. These points are often used by examiners in MCQs and conceptual questions. Short exam-ready summary. Provision is a charge against profit created to meet known liabilities or losses, whereas reserve is an appropriation of profit created to strengthen the financial position of the business. Provision is compulsory and affects net profit, while reserve is discretionary and does not affect net profit. Conclusion. In conclusion, while both provision and reserve involve setting aside profits, they serve different accounting purposes. Provision is meant to cover certain losses or liabilities and is therefore compulsory, whereas reserve is meant to meet future uncertainties and is discretionary. Understanding this distinction is vital for correct accounting treatment, preparation of final accounts, and for answering conceptual questions in examinations and interviews.
Thank you.